Engagement letter. There should be a clear understanding of the terms of engagement between the client and the auditor. ISA 210 requires the auditors to document their understanding with the client in engagement letter. Engagement letter is a letter from auditor to the client which contains agreement between auditor and client for the conduct of audit and other services. This letter will be sent to the client upon engagement before commencement of the audit. Purpose of engagement letter: to minimize possibility of misunderstanding between client and auditor. The second one, to clearly define the auditor's responsibility and objective and scope of audit. To provide written confirmation of the acceptance of appointment. Content of engagement letter: the responsibilities of the auditor, management's responsibility for the financial information, identification of the applicable financial reporting framework for the preparation of financial statements, reference to the expected form and content of any reports. ISA 701 communicating key audit matters. A statement that there may be circumstances which the report may be differ. The terms of the engagement, including a statement that because of the test nature and other inherent limitations of the audit, there is an avoidable risk that some material misstatements may remain undiscovered. Access to whatever information the auditor requires, a request for the client to confirm the terms of the engagement by acknowledging receipt of the letter. For recurring audit, new letter may be sent if there is a change in the nature and size of the client business, the objective and scope of audit, and any other matters relevant fees, assistance from client staff.
Fraud and error. Fraud is an intentional misrepresentation of financial information by one or more individuals among management or employee or third parties involving manipulation, falsification, or alteration of records or documents, misappropriation of asset, omission of the effects of transactions from records or documents, recording of transaction without substance. Error is an unintentional mistake in financial information, such as mathematical or clerical mistakes in the underlying records and accounting data, oversight or misinterpretation of facts, or misapplication of accounting policies.
Setting audit objective. The goals of an audit must be in line with management assertions, which are the statements made by management about certain transaction types, account balance, presentation and disclosure that are reflected in financial statements. Auditors need to obtain evidence that supports each of the assertions for every material components of the financial report. Management assertions express or implied representation by management about classes of transactions, account balance, presentation and disclosure that are reflected in financial statement.
3 categories of assertions. The first one is assertions about classes of transactions: occurrence, completeness, accuracy, cut-off, and classifications. Second one, assertions about account balances, existence, right and obligations, completeness, valuation, and allocation. The third one, assertions about presentation and disclosure, occurrence and rights and obligations, completeness, classification and understandability, accuracy, and valuation.